The architecture of global finance rests not on gold reserves or marble columns, but on a far more fragile foundation, the assumption of accuracy in ledger entries. Every loan, every credit limit, and every risk assessment is entirely dependent on the accuracy of the documents exchanged between borrower and lender. When this accuracy is questioned, when the paper trail shows a discrepancy between reality and representation, the tremors are felt far beyond the accounts in question. We are currently witnessing a test of this architecture. The revelation of leaked internal documents from Deutsche Bank allegedly detailing 20 years of financial interaction with Mr. Donald Trump has transcended partisan political squabbles and delved into the cold, clinically sensitive realm of forensic accounting and banking regulation. What we are investigating today is not just a headline about a former president. It is a case study of the modern banking compliance system, the structural vulnerabilities of lending to high net worth individuals, and the conflict between political power and corporate governance. As reported, these documents do not simply tell the story of borrowed money. This offers a rare, unauthorized glimpse into how banks of global system importance manage or fail to manage reputational and credit risk when their client is a major public figure. To grasp the gravity of this moment, we must set aside campaign rhetoric and examine the situation from the perspective of a bank regulator or judicial overseer. We look at the valuation mechanism, how assets are priced, how risk is calculated, and whether safeguards designed to protect the financial system are bypassed, ignored, or simply circumvented. Deutsche Bank is no ordinary financial institution. It is one of the giants of European banking, a German powerhouse that has been aggressively competing with its Wall Street rivals for decades. Its history is complex, filled with periods of rapid expansion and significant regulatory challenges. To understand why these leaked files are important, it is necessary to understand the bank's unique position in the late 1990s and 2000s. While many American banks were pulling back from real estate loans they considered high risk, Deutsche Bank was in a phase of aggressive balance sheet expansion. They were seeking market share in the United States. This context is crucial because it explains their hunger for deals that other institutions might reject. The Private Wealth Management Division, a separate entity from the bank's commercial lending arm, typically operates with a different mission, developing relationships with ultra-high net worth individuals. At this rare level of banking, relationships are paramount. The documents now under review are alleged to stem from this intersection where relationship banking meets risk management. The corporate weight of these records lies in their bureaucratic processes. Banks like Deutsche Bank operate not through handshakes but through credit ratings, risk committee minutes, and compliance records. These documents are the bank's nervous system. If the leaked files indicate that internal warnings were silenced or valuations were accepted without sufficient verification, this points to a potential systemic failure in the institution's governance structure, affecting not only the borrowing institution, but also the lender's internal controls. Reports on the leaked files include numerous internal communications, loan applications, and financial statements. Overall, the allegations revolve around a concept known as valuation discrepancy. This occurs when an asset's value, a commercial building, golf course, or residential property, is stated at one price for loan securing purposes and at a different lower price for tax purposes or internal follow-up. The leaked materials reveal a pattern where the borrower's statement of financial position presents an optimistic view of asset value that doesn't align with independent market assessments or the bank's own internal evaluations. It's important to emphasize here that valuation in the real estate development field is rarely an exact science. It's a system based on projections, comparable sales, and future income potential. However, the reported discrepancies in these documents are being investigated not for minor differences but for fundamental differences in methodology. For example, if a property is restricted as a private club on the title deed, valuing it as a private residence for development purposes makes a significant difference to the asset's theoretical value. Allegedly, the documents show that such discrepancies were not merely bureaucratic errors, but may have been part of a strategy to lower the credit-to-value ratio, LTV. A lower LTV ratio typically allows the borrower to benefit from lower interest rates. Therefore, if asset valuation was artificially inflated, the bank may have been led to price the loan at a lower cost than its true risk profile. Herein lies the essence of the financial investigation. Did the bank suffer revenue loss and take on excessive risk based on inconsistent data? To understand how investigators are currently assessing this, we need to look at the anatomy of a financial investigation. It's a grueling process, not unlike the speed of the news cycle. When documents like these are leaked or a regulatory investigation is launched, the first step is a protective order. Every email, every text message, every draft table is frozen. Then investigators begin the monitoring process. They look at the flow of information. Who created the valuation? Who reviewed it? Did a credit risk officer flag it? If so, who invalidated it? The document suggests that these discrepancies were not merely bureaucratic errors, but may have been part of a strategy to lower the credit-to-value ratio. In the banking world, there's a system called Suspicious Activity Reports, or SARs. Banks are obligated to submit these to the federal authorities when they identify transactions that appear suspicious. One of the key questions arising from these leaks is whether Deutsche Bank submitted SRS regarding this specific information at the time, or whether the concern is only emerging retrospectively. Compliance officers act like a bank's internal police force. If the leaked documents confirm that compliance officers raised red flags that were subsequently ignored by the business side, the deal makers, this shifts the conversation from a story about a debtor to a story about a bank's compliance culture. Investigators are looking into what's known as willful blindness, a legal concept meaning an institution deliberately avoids learning the truth about a client's statements in order to allow the transaction to proceed. The alleged financial structures under scrutiny are quite complex. We're not talking about simple mortgages. These are typically unsecured or limited security loans backed by complex guarantees. In high-risk real estate financing, a personal guarantee often serves as security. The documents highlight instances where the strength of this personal guarantee was based on a net asset that investigators now suspect was significantly overstated. If a borrower claims a net asset of $5 billion to secure a $100 million loan, the bank feels secure. If the actual net asset is $1 billion, the bank's security is mathematically diminished. The interest rate is calculated based on this security. Forensic accountants analyzing these files will look at the debt service coverage ratio. This metric measures a property's cash flow against his debt obligations. If cash flow is also alleged to have been inflated to meet loan agreements, this constitutes a separate misrepresentation. Investigators don't immediately look for intent. They look for patterns. A single error in a statement is a misstatement. In 20 years of filings, the consistent adjustments made in favor of the borrower form a pattern that demands explanation. This is where the distinction between optimism and fraud is debated. The defense will argue that banks are capable and sophisticated entities that can conduct their own due diligence and do not rely solely on the borrower's figures. The prosecution or regulatory body will argue that the borrower has an inalienable duty of accuracy. The regulatory and legal response to a leak of this magnitude is a multi-seated battle. In the United States, banking is subject to a series of oversight saves. There is the Federal Reserve, which oversees the stability of the entire system. There is the Office of the Comptroller of Currency for national banks. And most importantly, there is the New York Department of Financial Services, which wields immense power due to its jurisdiction over Wall Street. The New York Department of Financial Services, NYDFS, has a history of aggressively enforcing sanctions against foreign banks operating in New York. Regulators are cautious. They react to evidence, not headlines. Their primary concern is security and integrity. And did these loans threaten the bank's solvency? Probably not individually, but did the approval process reveal a flaw in the bank's risk management architecture? That's a systemic concern. If a bank of global systemic importance like Deutsche Bank has a permeable compliance filter for political influencers, regulators see that as a contagion risk. We are likely seeing a coordinated effort between U.S. regulators and Bayern, Germany's financial regulatory authority, to determine whether the bank violated local banking laws in Frankfurt and those in New York. The judicial complexity here is high. Documents held in Germany, EU confidentiality laws, and U.S. subpoena authority create a legally complex environment that slows down the release of definitive results. Wall Street's reaction to these revelations is often misunderstood by the general public. The market doesn't necessarily panic about a borrower's morality. The market price is in uncertainty. For other major banks, JP Morgan, Goldman Sachs, Citi, Deutsche Bank, the leaks serve as a signal to clean the books. Every major institution is likely currently conducting internal reviews of its portfolios, which include high-profile political figures. They are checking their own exposure to reputational risk. In modern finance, reputational risk is a measurable liability. If a bank is seen facilitating questionable reporting, its cost of capital could rise, its stock price could fall, and its reputation with regulators could be damaged. Institutions are protecting themselves from narrative risk by distancing themselves. You will see a quiet period where CEOs of major financial institutions avoid directly commenting on the specific event, but issue general notes about commitment to integrity and enhanced due diligence. They are protecting their own institutions from negative consequences. The concern on the street isn't just about one client. The question is whether this investigation will trigger broader regulatory pressure on the entire private asset management sector. If regulators demand 100% independent verification for every asset in a high net worth portfolio, transaction costs for private banking will skyrocket. Wall Street fears regulatory overcorrection more than the specific scandal. This brings us to the analytical framework frequently advocated by corporate conservatives like George Will. While Will is a political commentator, his approach to such matters is deeply rooted in legal philosophy and corporate integrity. The George Will framework used to analyze this event requires us to separate President Donald Trump's personality from the rule of law system. The conservative argument for strict financial scrutiny is not about punitive measures against a political opponent. It's about preserving market efficiency. If the data entering the markets is corrupted, the markets cannot function. From this perspective, investigation is a necessary task of the capitalist infrastructure. If a contract is based on false assumptions, it violates the sanctity of contract law, a cornerstone of the free economy. The law and order perspective demands that white-collar misconduct be treated with the same rigor as street-level crime. Ignoring alleged banking misconduct due to the debtor's political status means undermining the very institutions conservatives seek to protect. This is a test of the system's ability to apply its rules blindly, fearlessly, and impartially. Therefore, the silence or cautious pronouncements of traditional conservative legal scholars are highly significant. Even if they oppose the political motivations of prosecutors, they acknowledge the legal difficulty of defending the alleged conduct on its merits. However, political consequences cannot be healthily separated from financial consequences. We are in an unprecedented period where the forensic accounting investigation directly intersects with the presidential campaign. For the Republican base, the timing of the revelations and the aggressiveness of the investigations are often seen as evidence of the arming of the justice system. The complexity of banking law allows for a narrative that dismisses these issues as victimless crimes. If the bank was reimbursed, who was harmed? This is a powerful political shield. It transforms the question of regulatory compliance into a question of harm, easier to discuss in a public forum than in a courtroom. Conversely, for the Democratic opposition, the documents represent confirmation of a long-standing narrative about the former president's business acumen. But there is a danger here for the political class: over-politicizing of banking. Investigation can backfire. The legitimacy of the findings diminishes if the public perceives regulators acting on behalf of a party rather than the law. We are seeing institutional distancing. Established politicians await the conclusion of the legal process while populist individuals use the investigation as fuel for a culture war. The statements of party leaders are carefully tuned. They allude to the seriousness of the allegations without verifying the accuracy of the disclosures and leave themselves a way out regardless of the outcome. We must also address the gap between media narrative and financial reality. Headlines are designed to create impact. Banking documents are designed for accuracy. While a headline might scream fraud uncovered, a document might actually show a qualified opinion from an auditor or a contract waiver from a bank. The media often confuses net asset, a subjective estimate of value, with cash flow, an objective measure of liquidity. The investigation has likely focused more on the latter than the former. Did the borrower pretend to have liquidity they didn't possess? That's a factual question. Debates about whether a brand is worth 1 billion or 100 million are subjective. Debates about whether there are 50 million or 5 million in a bank account are binary arguments. The risk of misinterpretation is high. The public generally lacks the expertise to interpret terms like intermediate layer loan structure or cross-collateralization clause. When the media simplifies these terms, the details are lost. The documents that emerge may also contain exoneration evidence, statements of pardon, warnings, and lawyerly language that softens the impact of aggressive figures. Responsible analysis must acknowledge that banks generally accept borrower estimates with some skepticism, but that this requires underlying cash flow to cover debt servicing. The victimless crime defense rests on this. If the bank knows the figures are exaggerated and still grants the loan because it is profitable, the charge of fraud becomes harder, but the charge of regulatory failure against the bank becomes stronger. Globally, this case is being watched with great interest in financial capitals from London to Singapore to Tokyo. The US dollar is the world's reserve currency, and the US banking system is the clearinghouse of the global economy. International standards, particularly the Basel III agreements, determine how much capital banks must hold against their risks. If a major U.S. borrower is found to have systematically avoided risk assessment protocols, this raises questions about the effectiveness of these international standards. Central bankers are using this as a precedent. If the U.S. legal system introduces a political exception to banking fraud laws, this weakens the U.S. position in organizations such as the Financial Action Task Force. Conversely, if the U.S. takes a very tough stance, possibly criminalizing standard real estate negotiation tactics, this could hinder foreign investment in U.S. real estate markets. International observers are looking for a Goldilocks solution. Accountability that affirms the rule of law without destabilizing the real estate finance market. The credibility of the American financial system is effectively on the court. We must also be realistic about the limits of disclosure. Leaked documents are like a glimpse through the keyhole of a mansion. We see what the leaker wanted to show us or what they had access to. We don't see the verbal conversations that took place in boardrooms. We don't see side letters that may have altered the terms of agreements. We don't see the entirety of the bank's internal discussions. The documents may be incriminating, but they can also be taken out of context. A draft assessment is different from a final presentation. An email expressing disappointment is different from a formal policy breach. Verification is a huge challenge. Without the full chain of custody, we have to trust the news organizations that have reviewed these files. There are also ethical considerations. These are private banking records. The breach of confidentiality is significant. While the public interest argument is strong because the subject is a former chairman, the precedent of leaking customer files is a nightmare for the banking sector. Every high-income individual now wonders whether their files will be next. This creates a deterrent effect on transparency. Borrowers may submit fewer written documents, which could make the system less transparent rather than more transparent. From a financial governance perspective, this event will likely lead to a lasting shift in how banks deal with politically influential individuals. The culture of compliance will intensify. We will likely see the implementation of far more intrusive enhanced due diligence protocols for any client with political connections. Banks may decide that the revenue generated from such clients is not worth the risk of reputational damage. We may see the political class withdrawing from banking. As large institutions retreat, only niche, limited banking institutions will remain to serve these individuals. Experts will likely use this situation to demand more detailed data from banks. We may see new rules requiring third-party verification for all assets above a certain threshold. This would completely eliminate the self-reported loophole. This will increase the cost of doing business, but it will close the loophole that allegedly allowed these discrepancies to persist. The lesson for experts is this: banks that are too big to fail are banks that are too big to manage without continuous and intrusive oversight. Relying on banks' internal models to calculate risk has proven to be a potential point of failure. In conclusion, when assessing the landscape laid out by these Deutsche Bank documents, We must resist the urge to predict a jury's final verdict or the outcome of an election. Legal process is set up to weigh evidence against a high threshold of reasonable doubt. What we can say with certainty is that the curtain has been lifted on the high-risk financial system. The institutions of the United States, its courts, regulators, and banks are resilient, but they are not untouchable. This investigation is of paramount importance to the concept of equality before the law. It questions whether financial rules are rigid barriers or flexible guidelines that bend for the powerful. The answer to this question will come not from news tickers, but from the quiet, methodical work of forensic accountants and the final judgments of the judiciary. Until then, the documents stand as evidence of a system caught in tension between the pursuit of profit and the imperative of truth. The world is watching, not only to see what happens to one man, but also to see if the ledger is still valid. The unfolding story of the Deutsche Bank leaks offers a rare, detailed look into the engine room of the Trump Organization's financial strategy and its interaction with global capital. To deepen our understanding, we must focus on net asset valuations and the mechanism of compliance with contractual terms, which are likely of central importance in the investigators' files. In commercial loans, a contractual term is a promise. The borrower commits to maintaining a certain level of cash, a certain level of net assets, or a certain occupancy rate. If they breach these contractual terms, the bank has the right to recall the loan, demanding immediate repayment. The claim suggests that valuation inflation isn't just about obtaining the loan, but also about maintaining it. If the value of the collateral decreases, the borrower typically needs to deposit more cash or pay off the principal to realign the LTV. Allegedly, by artificially maintaining high valuations on paper, the borrower could have avoided these costly collateral calls. This is where the concept of loss becomes technical. Even if the bank doesn't lose the principal, it is deprived of its contractual right to demand more collateral. It is deprived of the opportunity to mitigate risk. In financial law, depriving a counterparty of their contractual rights through deception is a separate type of fraud from monetary loss. We also need to consider the role of the personal financial statement. For most Americans, mortgage applications require W-2 forms and tax returns. These are tangible data. For ultra-net worth developers, the KFB is often a document they create themselves. It lists intangible assets such as brand value or development potential. Deutsche Bank documents reportedly show that the bank's loan officers frequently applied a discount, a percentage markup, to President Trump's self-reported figures. For example, they might take an alleged $500 million asset and internally value it at $250 million. The defense would argue this proves the bank wasn't deceived. They knew the figures were optimistic and adjusted accordingly. This discount defense is legally strong. It shifts the narrative from deception to negotiation. However, prosecutors may be focusing on issues that even a haircut couldn't mitigate the alleged misstatement. For example, the square footage of an apartment or the zoning status of a building. If a document claims an apartment is 30,000 square feet, when in reality it is 10,000 square FT, no subjective valuation can cover up this factual error. This is the tangible data that typically forms the basis of a fraud case. It eliminates the ambiguity of valuation theory and leaves a clear dichotomy, true or false. The response from the New York Attorney General's office highlights the distinction between civil and criminal cases. A civil fraud case, as pursued by New York authorities, does not require proving will beyond reasonable doubt as a criminal case. It typically relies on the weight of evidence that business practices were continuous and fraudulent. The solutions here are financial in nature, the return of profits. This means the state calculates how much money was saved using the alleged fraudulent figures and low interest rates and demands that this money be repaid to the state. This repayment can amount to hundreds of millions of dollars, threatening to turn a business empire into cash, even without a prison sentence. Let's take a closer look at what was previously mentioned: Wall Street distancing itself. This isn't just about silence. It's about ending the relationship. When a client becomes radioactive, banks go through a process of exiting the relationship.